Imagine predicting a massive technological leap with perfect accuracy. You understand exactly how it works, you invest your capital, and your prediction comes true. And yet, you still lose almost all your money. That is the exact reality millions of investors faced in the late 1990s. The commercial internet delivered on its promises of global connectivity, but the dot-com bubble built around it still collapsed. Understanding exactly why that paradox exists, why a great technology can be a terrible investment, is the single most important skill you need to navigate today's artificial intelligence frenzy. Take a look at this chart tracking the NASDAQ Composite Index. From 1995 to March 2000, it surged roughly 600%. If you invested $100 in early internet and tech stocks, it turned into $700 on paper in just 5 years. But starting in March 2000, the index fell off a cliff. Over the next 2 years, it lost nearly 80% of its value. Trillions of dollars evaporated from global markets as companies with almost no earnings simply ran out of cash. Now, fast forward to late 2022. The release of ChatGPT triggers a massive influx of capital into artificial intelligence. Hundreds of billions in venture capital and corporate spending flood the market within months. The influx of money raises a critical question. How do we separate a valid technological leap from a financial bubble about to burst? To deconstruct market manias, we can use a diagnostic tool consisting of 3 layers: the technology layer, the business layer, and the psychology layer. Let's apply this to the 90s. In layer 1, the technology, the optimism was justified. The commercial internet drastically lowered transaction and information costs. But layer 2, the business models, revealed a different story. Dot-com companies spent heavily on marketing and gave away services for free. They prioritized web traffic and eyeballs over generating actual profits. Layer 3 is psychology. Fueled by cheap money and frequent initial public offerings, investors abandoned traditional valuation rules. Rising prices encouraged more buying, creating a massive fear of missing out. This unchecked optimism manifested physically. Telecommunication companies spent billions laying down fiber optic cables and networking equipment, expecting explosive, uninterrupted demand that didn't immediately arrive. When a genuinely useful tool is hijacked by flawed business models and euphoric psychology, a financial bubble inevitably forms. Applying that exact same 3-layer diagnostic to the 2020s shows striking similarities. The underlying AI technology represents a valid leap in computing capability and productivity. The psychological layer is also nearly identical. We are seeing the same momentum-chasing behavior, where stories of early investors making fortunes drive latecomers into the market out of pure FOMO. And we are currently living through the modern equivalent of the 1990s telecom overbuild. There is a massive, multi-billion-dollar infrastructure arms race happening right now in data centers and cloud capacity. Companies supplying the physical hardware for this infrastructure have seen extreme stock surges. Nvidia, for example, climbed over 1,000% from its 2022 lows by supplying the graphical processing units required to train large language models. The technology and the psychology align perfectly with the dot-com era. To see where history diverges, we have to look closely at the business fundamentals. Unlike the unprofitable experimental startups of 1999, the modern AI boom is largely driven by highly profitable tech megacaps. Companies like Microsoft, Alphabet, and Meta have massive, diversified revenue streams that can absorb heavy losses. But the hardware supply chain introduces a distinct economic threat called cyclicality. In the semiconductor industry, demand historically moves in cycles. Periods of severe chip shortages lead to massive factory buildouts, which inevitably result in overcapacity and plummeting prices. This chart demonstrates the core infrastructure trap. If end-user demand for AI software eventually flattens out, the rapid, aggressive build-out of physical hardware will leave the industry with a massive oversupply of chips. This is exactly why skeptical investors, like Michael Burry, warn that current semiconductor valuations do not account for this inherent boom-and-bust manufacturing cycle. A severe market correction in tech stocks doesn't require AI to fail. It only requires short-term software demand to fall short of the massive infrastructure currently being built. Financial bubbles are destructive to portfolios, but they serve a strange economic purpose. They fund the physical infrastructure that later generations of technology rely on. The dot-com crash left behind thousands of miles of cheap, unused fiber optic cable. Companies that survived the initial crash utilized that remaining infrastructure to build highly profitable global operations. Artificial intelligence will survive its current hype cycle. It will become embedded in global computing, even if many of today's inflated valuations collapse along the way. The ultimate lesson from the late 90s is this: you have to separate the inherent utility of a tool from the market price of the company building it. A great technology can still be a bad investment if you overpay. To protect yourself, look past the headline narrative. Focus strictly on cash flow, its unit economics, and its actual path to profitability. History rarely repeats itself exactly, but it often rhymes. Look at the data centers being built and the valuations being assigned. What do you think? Does today's AI market feel like 1999?